All right, today we are going to dive into one of the most important ideas in all of accounting, revenue recognition. Now, I know it sounds a little dry, right? But trust me, figuring out the when and the how much of counting your money is a fascinating puzzle, and it has absolutely huge consequences. Let's get into it.
So, here's our game plan. First up, we're going to hit the big question. Why does this matter so much? Then we'll walk through the 5-step framework that is the rulebook for all of this. After that, we'll put it to the test with 2 classic scenarios, recognizing revenue all at once and spreading it out over time. And finally, we'll see how the whole system handles a tricky product bundle.
Okay, so before we get into the nitty-gritty mechanics, let's talk about the stakes. I mean, why are there so many complicated rules just for counting money? It's a fantastic question, and the answer really gets to the absolute heart of what financial reporting is all about. I want you to think about any company's income statement. What's the number right at the very top? Revenue. It's the top line. And for most businesses, it is the single biggest number they report. Everything else, profits, cash flow, you name it, it all starts from that one number. So if you get that revenue number wrong, the entire foundation is shaky. And this is exactly where things get complicated, because it's not as simple as waiting for the cash to show up in your bank account. Should a company count the money when a customer places an order? What about when the product leaves the warehouse, or when it finally arrives on the customer's doorstep? The timing is everything. Choosing the wrong moment can completely change the story a company's financials are telling. And believe me, this isn't just some textbook theory. Getting revenue wrong is one of the most common ways companies commit financial fraud. The SEC is constantly on the lookout for businesses playing games with their revenue to make their performance look way better than it actually is. And the consequences? They can be absolutely devastating. So to clean up this mess and create a level playing field for everyone, the standard setters came up with a single universal solution. It's a 5-step model, and its entire job is to answer those 2 critical questions. When should we recognize revenue, and how much should we recognize? This whole giant topic really boils down to this one core principle you see here. Recognize revenue when you transfer goods or services to your customer. That's the destination. And these 5 steps we're about to cover, well, they're the roadmap that gets us there, the exact same way every single time. And here is that roadmap. Step 1, you identify the contract with the customer. Step 2, you figure out exactly what you promised to deliver. We call those performance obligations. Step 3, determine the price. Step 4, if there's more than one promise in the deal, you have to allocate that price between them. And finally, step 5, you recognize the revenue when you've actually fulfilled your promises. So enough with the theory, let's put this into practice. Let's start with the most common kind of sale you can imagine. A company sells one product and it's delivered all at once. This is what we call recognizing revenue at a point in time. Let's meet our example company, TrueTech. They're selling 1,000 of their gaming consoles to a retailer called Comp Stores. The key date here is January 1st. Why? Because that's the day the consoles are actually delivered. That is the moment that Comp Stores takes control. They have them, they own them, and they bear the risks. That's the moment we've been looking for. So what does this look like in the accounting records? Well, just like this. Because the one single promise to deliver the consoles was completely fulfilled on January 1st, TrueTech gets to recognize all $240,000 of revenue on that one single day. It's a textbook case of point-in-time recognition. Okay, that makes sense for a physical product. But what about services? You know, like a Netflix subscription or a gym membership. You don't get the benefit all at once. For these, we have to recognize revenue over time. So how do we know if it's an overtime situation? The framework gives us 3 criteria. Does the customer get the benefit while the service is being performed, like a cleaning service? Does the customer control the asset while it's being built, like a custom home on their property? Or is the thing you're making so specialized that it's useless to anybody else? If the answer is yes to any one of these, then you recognize revenue over time. So let's go back to TrueTech. This time, they're selling a 1-year subscription to their online gaming network. The customer gets to use it for 12 straight months. They are consuming that benefit of access every single day. This clearly meets that first test we just talked about for recognizing revenue over time. Now, check out how different the accounting is. On January 1st, TrueTech gets $60,000 in cash. But, and this is so important, they haven't earned it yet. They owe the customer a year of service. So that money is recorded as a liability called deferred revenue. Then, month by month, as they provide the service, they get to recognize 1/12 of that total,
$5,000, as revenue. This perfectly matches the revenue with the service they're providing, which gives investors a much more accurate picture. Okay, time for the final boss. What happens when companies sell products and services together in one big bundle? This is where the five-step framework really shows its value.
You see this happen all the time, right? You buy a new phone and it's bundled with a service plan. Well, in our example, TrueTech is now bundling the console and a 1-year subscription together for a single price of $250. So, now what do?
This takes us straight back to our framework. Specifically, step 2, identifying the distinct promises. And in this bundle, there are clearly two separate promises being made. First, there's the delivery of the TriBox console, which we know happens at a point in time. Second, there's providing 1 year of access to TriNet, which happens over time.
And now for step 4, allocating that price. We can't just guess how to split up the $250 price tag. The rule says we have to use the standalone selling prices. We know the console sells for $240 by itself and the subscription sells for $60. Together, that's $300. So we just do the math. $240 is 80% of that total, $60 is 20%. So we allocate our $250 bundle price using those same percentages. And here is the grand finale, the journal entry on the day of the sale. TrueTech recognizes $200,000 in revenue right away. That's the 80% for the console. But the other $50,000, the 20% for the subscription, that goes into deferred revenue to be recognized bit by bit over the next year as the service is delivered. So you see, the real power of this five-step model is that it gives us a consistent way to analyze any sale, no matter how simple or complex it is. It forces us to break a deal down into its core promises and then recognize the revenue only when it's truly been earned. It just gives everyone a much more accurate picture of a company's real performance. So look, this framework is so much more than just a set of rules. It's a tool for thinking. It's a way to look at any business and truly understand how they make money. So the next time you're looking at a company, ask yourself, what are their revenue streams? How would you apply these 5 steps to their business? You now have the tools to deconstruct their financial story and really see what's going on.